Hi there. Let's talk today again about self-managed superannuation fund trustees and what they do need to look out for. I've been having the conversation with some clients lately around legislation that affects the duties and responsibilities of a self-managed super fund trustee. And a lot of trustees, it seems, still don't seek professional advice when it comes to insuring their fund members. Now, legislation requires all SMSF trustees to consider insurance as part of their investment strategy. It seems, though, that this obligation is being overlooked either through a lack of understanding or maybe a lack of interest. Now, the Superannuation Industry Supervision Act 1993 dictates trustees must formulate an insurance strategy that addresses the type and level of insurance that they consider for their members. Further to that, though, trustees must be clear on the basis for their decision to offer and implement such insurance. They must take into account the position of each of the fund beneficiaries and also need to be clear on the method that they've used to determine their decision. The trustee needs to show that they've considered the cost to all beneficiaries of acquiring insurance of a particular kind or at a particular level. Now, in practice, most SMSF trustees are more concerned, of course, with growing the value of the assets inside the fund and not necessarily about the insurance held for its members. So while the trustee may indeed be an astute individual and an educated investor, they may not be adequately protected if the unexpected happens. Further, if they don't comply with this legislation, they do run the risk of being in breach of the superannuation law. They run the risk of becoming a non-compliant fund and therefore being subject to serious penalties. Thanks for listening.